If you're applying for a mortgage, you're going to need to know which one you're after. I know it sounds obvious, but if you're new to this and maybe you don't even know what kind of mortgages are out there, that's what this series is all about, so that when you speak to your mortgage advisor, you have some basic understanding. We're going to go through the most common types of rates together now, and there are 4 that I'm going to go through.
If you're applying for a mortgage, you're going to need to know which one you're after. Sounds obvious, doesn't it? But if you're new to this and maybe you don't know what kind of mortgages are out there, and that's what this series is about. So let's go through the 4 most common types together now. And here's Sarah with her trusty whiteboard and pen to walk us through it.
I'm very excited about this.
So first of all, we have our fixed rate. So your fixed rate stays the same for a set period of time, usually 2, 3 or 5 years. So your monthly payments will not change, which is great when you're thinking of budgeting and some peace of mind. Then we have a tracker rate. Now your tracker moves in line with the Bank of England base rate. When the base rate goes up or down, so will your monthly payments. We have a discount rate, and you can get a discount on the lender's standard variable rate, also known as an SVR, and that will be for a set period. So your payments can still change up or down, but it usually starts cheaper than the lender's SVR. And then we have the standard variable rate, or SVR, and this can change at the lender's discretion. And this is what you would automatically fall onto once your fixed rate or your tracker rate ends.
I'm going to put a big cross next to this one because we don't want you going on the SVR. This is what you're going to fall onto, as Gemma just said, but it's usually a lot higher than your fixed rate or your tracker rate, and there should be so many other options for you. So make sure your advisor, whether it's Gemma or someone else, speaks to you 6 months before that rate runs out, no matter which one you pick, so that they can put you onto a different rate.
Exactly, but you're not expected to know this stuff. Ask the experts like myself, and we are here to make it make sense for you. It is literally our job.
Since every mortgage comes with an interest rate attached that you're going to have to pick, it's really important that we get to grips with interest rates as a whole. So let me bust some myths for you on these, my favourite bit. Myth number 1, the lowest interest rate is always the best deal. You might be shocked. True or false? It's false. A super low rate might come with a large arrangement fee. So always check the total cost over the full deal period, not just the rate, but your advisor should do that for you. Myth number 2, everyone gets the same rate. No. Rates are personalised. They depend on your deposit size, your credit score, your loan to value, and the lender's criteria. So someone putting down a 20% deposit will usually get a lower rate than someone putting down a 10% one. And myth number 3, once I get my mortgage, that's it. Your mortgage is not a one-time decision. It's something that you need to review regularly. So although you might pick a 30-year term, you're going to review your mortgage every few years depending on what rate you pick. When your fixed term ends, if you don't do anything, you'll move onto your lender's SVR, and that is almost always higher than rates on the market. So make sure your advisor is speaking to you 6 months before your remortgage is due, and they can work with you to get a new deal that suits the next stage of your life. You are not on your own here. This is On the Ladder, and you've just taken the next very important step. Make sure you subscribe to stay with us all the way to your first home. And as always, if you've got any burning questions, put them in the comments and we will get back to you. See you soon for the next episode.